Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we're back for another weekly video with our friends at Strategas. Today, I'm thrilled to be joined by technical strategist Todd Sohn to talk through a few market items. Todd, how are you doing today?
Hey, Ross, great to be here as always, and happy to chat with you.
Yeah, thanks for jumping on with us. And it comes as the quarter is coming to a close, and one of the big themes that we've seen in the past couple of weeks is interest rates moving higher again, and the growth value trade switching again. It's a theme that's played out up and down over the course of this year. You all have talked about cyclicality reemerging in a lot of your work. Could you give us a high level overview of your thoughts there?
Yeah, I think what's most interesting is that you had rates go from about 175 or so earlier in this year, all the way down to the 120s. And while that happened, cyclical groups such as financials and materials and even the industrial energy names actually held up pretty well, right? They consolidated in what we would describe as an orderly fashion. Of course, there were some shakeouts in certain names, but all things considered, given that rate decline, we like what we saw, the cooling off from a lot of those different names. And now you're starting to see them improve along with the rate backdrop being more supportive now as we're pushing up against 150. And so if you're looking for a timely space, look to the banks, which are starting to resume higher. Look to these industrials, and energy has been phenomenal. I've had a great response to oversold conditions recently. Conversely, on the other hand, even as rates declined throughout the summer, you never really got much out of the average tech stock. Of course, the Microsofts and Apples of the world continued on their way, but you saw a lot of deterioration from down the cap scale, and that's starting to accelerate as rates increase. And so we think there's a lot more risk to the downside for the average tech stock. That is an important barometer that's going on right now. We would stay involved with those cyclical and value names with stronger trends.
Yeah, that's been really instructive over the summer. One sector that you didn't mention, but is an interesting one with the rate backdrop, is real estate. So the kind of high level analysis would say rates rising, bad for a high yielder like real estate, but you all recently upgraded them. They're tops in your rankings, and they've performed really well throughout the year, kind of regardless of what rates have done. So how are you all thinking about real estate at this point in time?
Yeah, and here's the thing with real estate, as you mentioned, best group in our technical rankings, great absolute trends and relative trends. So it's a place that you can find nice looking names that are actually outperforming. And here's what's important about real estate. The sector itself has pulled back here a little bit, but a lot of that has been influenced by the rate sensitive tower and data names, right? The infrastructure-esque names that are being hit by this jump in rates. Whereas what we like is the consolidations and some of the improvement going on from the retail names, the office REITs, and the hotel REITs. That's more consistent with the cyclicality we're seeing from other sectors. And so if you're looking within real estate, it's a very diverse place. Look to the reopen type names, look to the value names, favor those over the growthier tower-esque names that are much more affected by interest rate. And so we think that's an important distinction with real estate. But again, the whole broader space is still a really firm condition with those trends that we've seen. And we think, again, you want to stick with cyclicality emerging from the reopened retail names.
Well, and let's finish here. One last place that you all have noted kind of reemerging cyclicality, if you want to talk about it as a high level theme of this video and some of your all's work, is Europe. We focus a lot on US. We try to fight the home country bias, but it just happens no matter what. So let's talk about Europe a little bit. Do you like the space? And if so, would you be looking to some of those cyclical sectors over there as well for folks with more global portfolios?
Yeah, absolutely. Here's a key thing to keep in mind with Europe. I think we've ignored this region for the better part of a decade. But what's happened here in the US now is you have major market cap risk with the Apples and Microsofts and Amazon making up a quarter of the S&P. And when you dig into some of the cap weight sectors here, they're making up 30 or so percent. And so we think it makes sense to look abroad to Europe, which frankly has not worked in over a decade. And when you look at the leadership there, you're seeing the banks start to work again. You're seeing rates in Germany and across the region accelerate higher. Energy has held up very well there. And industrials have been leadership for this entire time. And so there is cyclicality reemerging in Europe. It is very, very timely. And that is not a index, the Euro Stoxx 600, that is exposed to growth as much as, say, here in the US. So if you are looking for more value and outside of our borders, definitely look to Europe. And again, to those groups like the energy, the banks, and industrial names. I think are pretty underowned in our work, and from many clients that we speak to, just do not seem to be too involved there yet. So that is absolutely another area of opportunity for what we like to think, at least into the early part of next year.
Awesome. Well, we love timely, we love actionable, and you've given us plenty of both. So we really appreciate the time, and look forward to speaking with you again soon, I hope.
Great. Thanks, Russ. Appreciate it.